Well, my name is Chad Hart. I'm an extension economist here with Iowa State University. And I guess first thing I should tell you is I've been sponsored by the Psychiatrists and Bartenders of Iowa. My unofficial nickname this year is Dr. Doom. We're going to talk about the crop markets. So you've already got a flavor for where I'm going to take you. But we're going to discuss what's going on with the markets these days, because when you look here, get this technology to work. What we've got is a situation where the last 3 years in a row, we've produced some of the best crops this country has ever seen. As we've done that, we've taken a big hit on the marketplace as you look out there. What you're seeing here, these are the latest numbers from USDA, updated yesterday. Looking at our corn supply and use here in the U.S. As you look at the top part of this table here, the stuff that's in the bright white on the top, that's the supply side. Where you see this gray box, that's the demand. Down here in the bottom line, that's the price. So let me start up there on that third line when you look at production up there. So you can see here, 2013, 2014, and the numbers for 2015. Those are the three largest corn crops the U.S. has ever produced. So we have been highly productive over the past few years. And it's that productivity, I would argue, that is limiting where markets can take us today. Because as I look at the demand side, the gray box here, you look at those same 3 years, and what you're seeing are the three best demand years we've ever had as well. In fact, I would argue right now there hasn't been a time where more people have wanted our product. The idea is our demand is good. It's not a demand issue when we look at the price levels that we're facing here. This is more about the supply that we've been able to bring to bear, how that's overwhelmed demand, and that's what's been driving prices down as you look here. We've been building those ending stocks. The problem to me is as I look into 2016 and I get ready to add that next column over here, it looks eerily similar to 2014 or 2015. I think we'll hold roughly 90 million acres in corn production again in 2016. Right now, we'll start the year off with plenty of moisture to grow that crop. And if I get 90 million acres again, I've got the potential for another 14 billion bushels of supply to hit the marketplace this coming year. At a time when demand at its best was 13.75. So right now, the most likely scenario is we're going to do this all over again. We've been in this situation in 14, we did it again in 15, and right now it looks like we're going to do it again in 16. And it's not just the corn market that finds itself in this situation. When you look at the soybean market, it's basically got the same tale. Production the last 2 years, record levels. Demand, very strong right now. And so we find ourselves again in that same boat with ending stocks, building prices being lowered. Hence why I've been sponsored by those psychiatrists and bartenders. As you look here, I'm going to say that, thinking about this, are we going to struggle here over the next, I'm going to argue 2 years? I would say yes. The low prices that we're seeing today will likely sustain themselves for at least another year. But we also see the seeds of our recovery to higher prices, given the numbers we've got here. Demand is very strong. And with prices staying low for a little while, it will remain that way. And it will continue to grow and build. And as it does, and our supplies hopefully eventually will shrink, we will see prices recover. But it's going to take a little while to get there. Now, when I look at the supply side, and the reason I think 2016 will replay 2015, well, let me start you out with a map of 2015 corn yields. This is how the final numbers came out, USDA's estimates as of yesterday. So this is also your eye chart examination. For those of you sitting in the back, if you can read the numbers in each state, your eye doctor is going to be very happy with you. It's also color-coded to make it a little easier for you. In this case, the blue states, those are ones where their corn yields went up compared to 2014. The red states, that's where your yield went down. The gray states, are there any grays? Yeah, there's a couple here. That's where your yield stayed the same. The white states where you see no number, you don't grow corn. What you see here is that the northern and western corn belt sort of came through like gangbusters in 2015. In fact, that was the great debate in the marketplace. If you think back to this spring and summer, the concern was we were seeing all this, these storms rolling through the central U.S., creating some prevented planting problems, especially right in through here. And what the market was debating was, will the prevented planting and the wet conditions down there be offset by something, by better crops somewhere else? And that's exactly what happened. We saw the better crops up here. In fact, for those of you with eagle eyes, everywhere where you see this little, well, for your younger folks, the hashtag, for your older folks, a pound sign there, that's indicating a record level yield in that state. So as you look here in Iowa, 192 bushels was the official estimate for the statewide average yield. That beats our previous record by 11 bushels. We blew the top off our record. But we weren't the only ones doing it. You look over at Nebraska, 185 record. South Dakota, 159 record. Minnesota, 188 record. Wisconsin, 164 record. The idea is the northern corn belt came through beautifully. And even though we did see a drop in the southern corn belt, it was offset. You look here at Illinois, 175 is where they ended up this year. Last year, they were 200. So if you think about 2014, it was more about the southern corn belt producing a great crop. 2015, it was more about the northern corn belt producing a corn crop. Either way, we were staring at a very good to near record corn crop in the U.S. the last couple of years. Incredible supplies. Now let's think forward into 2016. So you look at this map, this was 88 million acres of corn planted this past year. I'm going to argue we're going to see probably 90 million acres planted this coming spring. So even though prices are lower, I think we're going to see even more acreage headed into corn. Why do I say that? Well, let's think about the area that came into corn over the last few years. I remember when I moved here to Iowa back in the late 90s, the idea was corn was planted on 75 to 80 million acres. Now I get to talk about 90-some million acres. Where did that additional land come from to go into corn production? I'm hearing it mumbled out there. Great Plains is one area. Southeast is another. The idea is, yeah, those guys came in. They were chasing after $7 corn. They were chasing after beans in the teens. Where did they come from? What had they traditionally done? Wheat, cotton, heck, even some pasture land came in the corn production. Is that land going to go back to those other crops? Has anybody looked at the wheat market recently? Given the laughter, I'd say you have. It looks like corn. It's not offering much of a return. Cotton, not offering much of a return. So the idea is the land that came in over the past few years is likely going to stick around because it's got nowhere else to go. In fact, I like the joke that, I've looked over the entire cash crops complex looking for a profitable crop. Because that's what usually drives acreage. If I can find a profit, I'll move to plant that crop. Well, I can only find one right now. Here's the problem. It's only legal in 3 states. And you might have a little trouble shipping it across state lines. But that's sort of the catch-22 we find ourselves in here right now. Other crops aren't offering any sort of profitable opportunity either. Since none of them are, farmers tend to hunker down and do what they just did. Well, what did they just do? They produced the 3rd largest corn crop we've ever seen. In fact, if I could take you back last year, down in here, that's when they were setting record yields. I grew up down here in southwest corner of Missouri. When I grew up in that county, there were 2 corn farmers. I knew them both. We were cow-calf land. We were pasture. When I go back down there today, half the county's in corn and beans. They think they're crop farmers now because they've been able to do that the last couple of years. And my argument is for 2016, they'll continue to try. And as long as they do, that means I've got 90 million acres of corn. That means I've got 80 million acres of beans. And that means I've got the potential for another set of large crops here in 2016. And it means the continuation of the low prices we're experiencing today. And it's not just here in the U.S. that we've got a supply issue. I'm going to argue it's global. When you look at the last 2 world corn crops, you're seeing the 2 largest corn crops the world has ever seen. We weren't the only ones chasing $7 corn. Everybody else was as well. And in fact, if anything, I'm more worried about beans in 16 than I am corn. Why? Because when you look at the soybean world table, again, the 2 largest crops the world has ever seen, but which way is production going? And as I look into 2016, what do I expect it to continue to do? I think world production here will continue to grow because there's some definite, different signals being sent to producers worldwide here. When you think about your prices today versus where they were at a year ago for soybeans, what's happened to your price levels? Have they done this? Yeah. If you were a Brazilian or Argentine farmer and I asked you that same question, you want to guess what they would say? They're staring at higher prices. In fact, in some cases, significantly higher prices. What do you think they're going to do in 2016? What should they be doing in 2016? They should be producing more. And that's exactly what I think we're going to find. So instead of this global competition decreasing with these lower prices, I'm going to argue they're going to continue to increase. So we find ourselves in a rough spot here. That's why throughout the course of this day at this Crop Advantage meeting, you're going to hear a lot of talk about how do we manage margins in this low price environment? How do we manage our inputs to deal with these low prices? Now, when I looked, I also tried to put in, the seeds of our growth out of here, and I'm going to argue it's the demand side that will eventually help us out. But it's going to take some time. Because when I look at demand, like I said, demand is very good right now. In fact, it's almost never been better. Start with the feed demand side of the equation. Because when you look, feed demand is still our major driver in terms of overall usage of our crops. And the key feature here to me is this far right-hand column here. Looking at meat production and how's that expected to change over 2016. What we're seeing here is growth across the board. That we expect to grow more cows, more pigs, more chickens as we go through 2016. And to me, that's a very good thing. Because for every animal we're growing, that means more feed demand. And this is exactly the type of growth we're going to need in this market for prices to go higher. It's nice to see that it's consistent in this case across the board. Over the past couple of years, it's been the chickens and the pigs that have been growing. The cows were the ones we were waiting for that turnaround to happen. Well, it's finally coming here in 2016. And so over the past 3 years, we have watched feed demand build by over 1 billion bushels on the corn side. It's incredible growth. It's really good growth for us. It's just not quick enough to pull our prices higher right now. If you will, we've been able to overproduce to even overwhelm that type of growth. Shows how productive we have been. So if this is growing, well, what's going on in the other sectors of demand? There's where we're finding some weakness. And I would argue if you're going to look for one wild card, one surprise that could hit us in 2016, I'm going to have to argue you're going to have to look at the export markets. I think on the ethanol side and on the feed side, we know what's going to happen in 2016. We've got a really good feel for it. Where we don't is on the export side. And right now it's the export markets that are our weakest. That's where we have seen a significant decline in demand. And there are 3 good reasons why we're seeing it. But I'm also going to argue this is the place where we could see the most surprise over the course of the coming year. Our exports tend to be our residual market. They're the ones that move around to sort of help us balance out. And as you can see, thus far this year, the movement has been down. We're down about 25% from where we were at this time last year in terms of exports. And it's been pretty much a broad-based cut. Almost everywhere you look, we're in negative territory. In fact, the only market that's been growing for us is Mexico, and that's because of the long-term sustained drought that they've had over the past several years. When you look at the export side, number one reason you're seeing this sort of drop is because of those large supplies. As I mentioned, the rest of the world has been producing a lot of corn and soybeans over these past couple of years. So if they're producing more crop, do they need to buy more from us? No, they've got their own. And just to show, this is also in the soybean market, as you look there as well. Now, when we think about soybeans, we tend to think about China because they tend to dominate the market. But the idea is that the pressure is on both sides. We're having trouble right now in the international markets. So reason number one, those large supplies. Reason number two, the strength of our dollar. When you look at what the dollar has done over the past year, year and a half, it's an incredible run. But have we been through something like this before? Yeah, it wasn't that long ago, right here. You look back there in 2008, you see a very similar run. Well, what created that run? Why did the dollar strengthen so much in 2008?
Best house in a bad neighborhood.
Best house in a bad neighborhood would be the correct line here. It was the Great Recession.
Economy's good.
Our economy's okay. And in fact, that's the game here. When you see strength in the US dollar, what you're seeing is that the global investor out there, they're looking for a safe haven investment. They're looking for a place to park their money. And what's the biggest safe haven investment in the world? It's the US dollar. Why? Because we are the best house in that bad neighborhood. Is our economy growing greatly right now? No. But compared to other parts of the world, it looks good. Europe still has troubles. Japan is in recession. You've heard the stories about what's going on in China and the problems with their stock market. So the idea is, as we look at the global economy, it's struggling right now. And when the global economy struggles, people come running to the dollar. And that's exactly what we've seen this run up. It also points to, when will this stop? Well, if you think back here to 2008, when did it stop? It's when the global economy started to build back up again. And that's what we're looking for here as we go into 2016. When will that occur? Well, if I knew that, I wouldn't be in front of you today. Me and my Powerball ticket, we'd be down in Aruba. But the idea is, as we look at the global economy, it looks like it's going to struggle for a while in 2016. So we're likely going to see this dollar strengthening, sustaining itself. And as the dollar strengthens, what it does is it makes our corn, our soybeans, our beef, our pork more expensive to the rest of the world. That's reason number two, our exports are struggling. Reason number three, related to this. Now, when I throw this up there, you look up and you see crude oil prices. When I look at this graph, I see global income. Because I want you to think about those countries that we sell our corn, our soybeans, our pork, our beef to. Where do they get their income? What drives developing countries? Yeah, I would argue it's oil, it's natural resources, and those sales. What's happened to their incomes over the past year? Looks like it's been cut in half. In fact, this graph makes the corn market look good. While we have watched our global incomes drop, reason number three, we're seeing exports drop. Let's face it, if you don't have the money, it's hard to buy the goods. And so when you look at these significant headwinds we've got on the export side, actually I'll take you back here. I'm surprised this picture looks this good. I think we could have expected a larger drop than what we're seeing here. In fact, if anything, I would say that bodes well for us as we go forward. That demand is holding in there despite all these problems. And in fact, another place that I was watching for it here was in the ethanol market. Now what I've got here is a graph for you showing what each and every week, how much corn we use to produce ethanol in this country. And as you can see here, back in 2012 when we had $7 corn, we saw a significant drop off from the ethanol industry. No one wanted to pay $7 for corn if they didn't have to. And we saw the ethanol industry tail off for a while. But as crops grew and prices dropped, we saw the ethanol industry come back in, and they put themselves on a very strong expansion mode over the past 3 years. To where we're now using on average over 100 million bushels each week to produce fuel. That's an incredible amount of demand. But here's my challenge. As we look forward now, will we continue to see this type of growth? If you were to draw out the line from here on out, does it keep going up like that? And the answer is correct. That is no. Why? It's not crude oil price. I'm going to argue here's the problem. When's the last time we built a new ethanol plant in this country that was corn-based? Actually, we built one recently. Anybody want to guess where it is? North Dakota. Why we built it up in North Dakota? Think back to that map. They're producing a lot more corn up there. That's the first ethanol plant we've built in this country, corn-based ethanol plant, in the last 3 years. And that's the issue. As you look here today, that is every ethanol plant we've got in this country up and running as hard and as fast as it can. It takes 2 years to build an ethanol plant. So my argument as I look at this graph is get ready for it to flatline. We're going to be stuck here, I think, for a while. Because we really don't have much capacity to continue to build on. And I'm going to argue it's not necessarily crude oil prices. Think of this. You've had this run in ethanol. They've continued to produce more and more ethanol, even though oil prices have fell through the floor. This also points to the success the ethanol industry, I would argue, has had. This industry has matured. It's able to compete in a low-cost environment. Think about that. Just a year and a half ago, you were staring at $100 a barrel crude oil. And at the time, take you forward here, the ethanol industry was back here producing right in this area. Now we're talking about $30 a barrel crude oil, and we're up here. We're producing even more. You're only able to do that if you're able to compete. How have they been able to compete? Well, let's think about what happened to them. When they had $100 a barrel crude oil, what were they staring at in terms of corn prices? For a lot of time, they were staring at $7 corn. Well, corn fell to $3.50, oil fell to $30. They're about in the same boat. That is, their margins have been protected, if you will, because both their output price and their input costs dropped at the same time. And not only are they competitive enough to compete here domestically in the U.S. as far as the market is concerned, we're actually exporting ethanol, even though the oil prices dropped. That's a true sign of competitiveness, because that means we can price competitively against oil. And so ethanol has provided as much demand, I think, as it possibly can, and that's the problem. That may be as good as it gets for a while. And so when you add in 5.3 billion bushels of demand for feed, 5.2 billion bushels of demand for fuel, give me another 1.7, 1.8 billion bushels for exports, another 1.3 billion bushels getting burned in like corn sweeteners and starches. And you're talking about good, strong demand. But it's just not strong enough to pull prices higher. And that's why you see a situation that looks like this. In this case, the green that you're seeing here, these are the futures market prices from Chicago, close of day yesterday. So this is taking into account the USDA report from yesterday. What you see in those big black numbers, that's me translating those futures market prices into national cash average prices. USDA's official estimate for the 2015 crop right now is $3.60 a bushel. I'm going to tell you the market is not that optimistic. They say $3.50. As we look into 2016, the market then gets back up there to that $3.60 range. As I look out into 2017, the market says $3.80. So do we see improving prices in our future? Yes, but slowly improving. Because price is only half the story when we're talking about farming. I've got to line this up against our cost to produce this bushel of corn to sell. Then what's our cost structure right now? Well, my colleagues at Iowa State, they ran the numbers this year, and they project for 2016 the cost to produce a bushel of Iowa corn is going to be around $4.15. Where is that on my chart? Well, it is there, thank goodness, so I won't need a new chart. But as you can see here, it's going to take us a while to get there. That's why we're going to talk about low margins for a while. That's a situation for corn. Here's beans. It's the same story. As you can see here, USDA updated, $8.80 is what their official estimate is. Market says $8.60. In fact, it actually takes a chunk out of us next year, worrying about that South American crop. And it's going to be slowly building here. Here, my production cost estimate is still north of $10. I think I need a new chart. In fact, I may need to raise the roof on the place too. That's the issue we find ourselves in. Margins are low right now. They've been here for some time. This is for the crop that you've got in the bin right now. So we look at 2015. Was there a chance to market that profitably over the past few years? Yeah. You look back here in 2014 and we offered some profits. But once we figured out the 14 crop was going to be a whopper, you saw those margins decline. And when we figured out the 15 crop was going to be good, we knocked that down again. And we find ourselves in the hole today. As I look at the 16 crop you're about to plant, we started out in the hole. We had one little shot for corn there in June and July. And I'm going to argue it's this situation here is what on the marketing side we're going to be looking for in 2016. As I said, the most likely scenario is a lot of supply. But the marketplace always likes to try to kill the crop at least 3 times before we harvest it. This was the example from 2015. What happened there in June and July that caused the price spike? That was the worry about that prevented planting down there in Missouri into southern Illinois. And we saw prices spike up because, well, you know, it was looking like a couple of million acres were probably being taken out. Why did prices drop so quickly then afterward? Because we figured out those acres were in Missouri. Who cares? And I can say that. I'm from there. That was sort of the issue, if you will. We tried to figure out, is the weather scare big enough to actually move the marketplace? But when we get those weather scares, what they offer are opportunities. As you can see here, that offered an opportunity to get back to break even. And it's exactly those type of opportunities what we're going to need to look for and take advantage of in 2016. And we do have the setup for it. As I look at the way we're going into the spring, we're definitely sitting on adequate moisture. In fact, I would argue we're sitting on surplus moisture. I think there's going to be a lot of concerns of will we be able to get out in the fields in a timely manner? Will we have some prevented planting issues? And if we do, what does that create in this marketplace? Spikes like that. But we'll need to take advantage of those. Because my fear is, just like that one, they'll pop up, they'll be short-lived, and then they'll disappear again. And at least the most general trend says we'll be down here instead of above that line most of the time. And in fact, what I would argue is this is just returning us back to normal. For those of you who have seen me before, you'll know this is my favorite chart of all time. This is my lifetime in the corn market. The blue line that you're seeing here, that's the average price we've received for a bushel of Iowa corn. The red line is the cost to produce it. When you got blue over red like we had a few years ago, you've got profits. When you've got red over blue like we've got now, you've got losses. But as you look over my lifetime in the market, what's the average return on a bushel of Iowa corn? It's 0. As it should be. Farming is a competitive industry. And in competitive industries, when we've got profits like we had here, what happens? We overproduce. We expand the industry. Did we see that in the corn market? We ramped up you think back, in 2012, we put 97 million acres into production in corn. We ramped up production. As we do that, what happens to those two lines? Well, that's it. Yeah. As we ramp up production, blue line goes down. All else equal. And as we create that production, we got to get those inputs. We got to bid them up. We see that cost, that red line rise. And that margin that was once so beautiful collapses. The problem is, do we ever stop right here? Nope, we keep on going, don't we? And that's the situation we find ourselves in today. But it's a situation we found ourselves in before, and again, and again. We talk about ag cycles a lot. They exist for a reason. We're going through another one today. When you look back at those cycles, though, I want you to think, how many years do we tend to spend in that downturn? I look back here in the 70s, what? Probably 5 years? 80s was a whopper. The 90s, you had about a 6-year one. On average, looking back over time, when we see this type of downturn cycle, on average it lasts 6 to 7 years. What year are we in that cycle? I'm going to argue year 3. We're about halfway through. And the way do we get out of these things? It's not new, it's not rocket science, it doesn't require us to do anything different. And I should also mention the idea is this is the corn table. I could put up soybeans, it's going to look the same way. Wheat's going to look the same way. Pork would look the same way. Beef would look the same way. This is how agriculture works. Not just during my lifetime, but since the dawn of time. And so that's why we're going to talk about margins and the downturn that we've had. Now, a colleague of mine put together this as just looking at what's the profitability we've seen on rented corn land over the past few years. So what we've done here is we've got the state average yield, the state average farm price. That shows us revenue over time. And as you can see here, revenue has dropped significantly the past few years. He's also included in here crop insurance on average. Then down here we got costs. And as you can see here, costs, have actually been fairly steady over the past few years, but are starting to work their way down. But the idea is that drop in income we've experienced due to this record high production here has put us in a negative margin hole that continues to build. And one of the things we have to do is figure out how do you manage to try to fill in that hole. One of the big things that he pointed me out to was looking at crop insurance and how your risk management moves help fill that in. Because if you hadn't had crop insurance, the holes were even larger and would have started earlier. One of the issues we're looking at within farming is that we've got to figure out how to fill in those holes. You've got to get income from somewhere to fill the gaps. Farming is like any other business. A business that is running in negative margin territory for a long time won't be business for long. And so as you can see, we've been steadily trending down. This was record high income. Should we have expected that to continue? No. A lot of my talk here the rest of this time is going to be talking about how we need to forget the last few years and remember about 2 decades ago. Because that was the last time we found ourselves in this situation with these negative margins. And the tools that got us out of that mess are the same tools that will get us out of this mess. As you look at soybeans, it's the same tale. We haven't dug as deep yet. And the idea is crop insurance helps pad that in as well, but we've still got a hole here. And one of the biggest things, and one of the hardest things to talk about is, if you will, what happened over the past 7, 8 years was that we changed the way we approached farming. When we had record incomes, when we had $7 corn, when we had beans in the teens, we didn't treat farming as a business. I would argue we treated it as an ATM. We got used to living high on the hog. One of the biggest things that jumped out at me was living expenses. We've been tracking those. We use the Iowa Farm Business Association records to look at that. And it's been amazing over the past 10 years to watch how living expenses have expanded on the farm. When I was growing up on my farm down in southwest Missouri, vacation meant going to visit the grandparents. Today, for most people, what's vacation mean? They're probably in Aruba. We geared up. We got used to getting that new truck, flipping it every year or 2 years. We got used to flipping that equipment very quickly, not getting many hours on it. We always wanted the nice, shiny, new toy. Well, the problem is, in a low-margin environment, you can't keep that up anymore. As you look back here, what my colleague did was he said, okay, how many acres do you need just to create $40,000 to cover living expenses? Thinking that's a minimum a family of 4 might need. Back here in 2012, it didn't take many acres to do that. Life was good. 2013, expanded a little bit. 2014, 15, if you're fully renting that land, you couldn't get there from here. That shows how deep the problem can get quickly. And this is just to show you, in this case, thinking about the equity you would need if you own that land. We've watched the need for capital increase greatly over the past several years. So what's it take to get us out of a profitability hole? Well, roughly, if you're sitting here thinking, okay, let's compare 16 revenues to 15 and do the same on cost of production. Right now, we're sitting in a hole of about negative $50 an acre. We're going to need something where, costs have got to drop and revenues have got to rise in order to get us straightened out again. Can you come up with a story that gets you there? Well, that's part of my job, is to get you there, because we've got to get you there with both crops, because we find ourselves in a hole for both. So let's talk about some strategies here. Well, actually, let's talk about 16 first. And here's the projections looking out. Does the hole get deeper? Yeah, looks like it will. Now, in this case, for 2016, we put in, if you will, a more representative yield for Iowa. Remember, 192, that's a record by far. That would have been close to the old record. And even with close to the old record, I'm still talking negative territory. Beans, the hole gets really deep. So that's why we're here talking about how do you manage these margins. All right, let's start with the first thing I'm going to point out. If you think back to the last several years, those profits, those also put the ag sector in a very good financial situation. Our debt levels are really good right now. Our equity position is really good right now. When we look at our balance sheet, we're good. Because even though we spent a lot of money, we kept some back. So is solvency a problem right now? No. Liquidity is. We got a cash flow issue. Right now we're pulling in less cash than we're spending out. But we have the cash to do that with right now. So what we're looking at here is, solvency could take a hit, but it's still strong. This is more of a strategy to get through the next 2 or 3 years, because we believe 2 or 3 years from now, things will balance back out again. But you got to survive for those next 2 to 3 years. Thing number one to look at is protecting your working capital. I'm going to argue right now, cash is king. Because if we are in this low margin situation, you don't want to run out. And so as I travel around the state, I'm noticing a few things. There are a few more boats for sale along the side of the road, trailers, some trucks. People looking to get some cash back. Why do they want that cash back? Because we need it back. As you look right now, now's a great time to look at the assets you've bought over the past few years and figure out, do you really need them or not? We need to be a much leaner, meaner farming machine. When you had $7 corn, you didn't have to worry about that. When you've got $3.50 corn, you definitely do. We need to evaluate our rented land. A lot of the growth that we had seen over the past few years was based upon just throwing that extra dollar at a new piece of land. But we can't do that anymore. And one of the biggest things I'm concerned about here is this managing taxes bit. Because I know this group. If there's the one thing you fear the most, it's paying the tax bill. And we try to defer that as much as we possibly can. Well, my concern is that we deferred a little too much. Because when that tax bill finally hits us, are we going to have the income to cover it? I'd rather pay a little tax now than a lot of tax later. And so be actively managing your taxes. Work with your financial consultants right now. Get that under control. When you look at strategy 2, it's avoiding shortages here. And the idea is plan for some shortages, especially if you rely on rented land a lot. The idea is the operating margins right now don't look good. And like I say, I don't expect them to improve very quickly. So we need a game plan that helps us deal with that. If you will, we're going to drain down some of the equity that we've built up in order to try to survive. Work with your lender to talk about operating loan and emergency loan terms. Because the idea is, are we going to have to fall back on debt a little more over the next couple of years? Yes, we will have to in order to survive out there. And be very careful with either new expenditures, trying to maintain those cash reserves. Again, the idea is cash is king right now. That's what's going to help us survive for the next 2 to 3 years. Another one, diversifying income. And this is something I've seen as ag has changed over the past couple of decades. The idea is anymore, it's the rare person who's just a farmer. Typically they're a farmer and seed salesman, farmer and a crop insurance agent. Usually there's some other type of income flowing in as well. We need that to continue. In fact, if anything, we need to figure out ways to continue to use our expensive assets to create more income. These were a couple of shots my colleague Alejandro Plastina took down in Ankeny a few weeks back. They're clearing snow, or they were waiting to clear snow. The idea is that was the game, looking for alternative sources of revenue. Because in an era where cash is king and margins are tight, any little dollar that you can eke out from somewhere else is a dollar that you can put in your pocket. And so we do need to do that. This is probably the one where you're going to hear the most about over the course of today, is looking at revising production costs. And in this case, the hardest one's the land rent, and there's been a lot of discussion about that over the past few months. Land rents are starting to work their way down, and they should. When you think about land rents or land values, they track with farm incomes, but they tend to lag behind them. And so as our incomes were rising a few years ago, land values, it made sense that they went up. In cash rents, they went up. Now that incomes have dropped, we're seeing the same thing happen with land values and with cash rents. It just takes them a while to do it. And that negotiation is painful, but it is going on right now. But I'm going to challenge you to look at all parts of your farm business. For example, Is Dr. Sawyer following me today? Yep. So Dr. Sawyer is going to talk to you about fertilizer. And one of the biggest things I know he's going to talk about is how much nitrogen we're applying. Well, I'm just going to put this seed in your head. Nitrogen is one of those assets, one of those inputs that you definitely need. We do need to spend some money sometimes to make some money. But we need to evaluate how much we need to spend. For example, if we could just cut our nitrogen weight by 20 pounds per acre, we're probably looking at a savings of maybe $8 to $10. Well, anytime I can save a little on cost is great, but I want to save that cost only when it doesn't impact my revenue. I want you to look for the bang for the buck. In this case, if that cut in nitrogen, if I don't have a yield drop, or say my yield drop is smaller than, let's say 3 bushels, just to round it for me here, the idea is then that sort of reduction makes sense. But if that reduction in nitrogen took me down 5 bushels, no, I don't want to touch it with a 10-foot pole. But I think we need to evaluate each and every input that we're looking at right now. Are we getting the bang for the buck there? It's not just your fertilizer. I want you to look at your herbicides, your pesticides. I want you to look at your seed. In fact, I'd say if I've got a punchline here, it's the idea is evaluate the business and talk to your experts, the specialists you work with. From your agronomist and your seed salesman to your ag lender and your landlord, you need to be talking. Communication is actually the easiest way out of a negative margin environment. Because if everybody knows where you're at and they're willing to work with you on that, it's going to make things go much easier. We're looking for volume discounts. We're looking for anything. Like I say, visit with your agronomist. Now's the perfect time as you're sitting here for Crop Advantage. You're out trying to update your production skills. We're trying to figure out how you minimize cost yet maximize production in a time like this. Actively manage risk. Big point here, know your break-even price. How do you know a good price when you see it? I'd argue if you don't know your cost, you don't know what a good price is, because you can't tell me. You can't tell me whether you're winning or losing. There were people, when we had $7 corn, that were still losing money. There are people, now that we're at $3.50 corn, that are still making money. Those that are making money today, they know their cost. They figured out how to work this. The idea is, get yourself a marketing plan. Work with your broker, whoever you're working with on the marketing side. Create a plan given these lower prices. For example, here's a question for you. How many of you have unpriced corn in a bin right now? Come on, raise those hands higher. I want to see them. What's your exit strategy? Given what you've heard from me today, what's your plan B? Because I think you're going to need one. I'm going to argue for those of you that didn't raise your hand, you're going to need that as well. We need to be thinking about our marketing and what we're going to do if we maintain these low margins. I love crop insurance as a risk management tool, but I'm going to tell you even there, look to make sure you're getting your bang for your buck. You may want to cut back on that. You may want to expand up. Depends on what your risks are on the farm, but I want you to evaluate every input situation you're making here, because that's the way you're going to control these costs and make that margin situation look better. I already mentioned the family living. I'm going to point out that it's across the board. The idea is this is a one it's really tough to pull back. Once you get used to living high on the hog, it's hard to pull back. But the idea is it takes a lot of land now to create $40,000. But let's face it, we're not living on 40 anymore, are we? Let me go to 70. But even here, we need to, again, go back. Farming is a business. We can't just look at it as like the ATM. It's no longer printing those checks for us anymore. And so, yeah, we may have to fall back and pull back a little bit on the fun things that we've been doing the past few years. You enjoy the profits when you have them. You don't have them anymore. Pull life back again until you get them back, and then you can enjoy life again. Securing repayment capacity here. Here's one of the weirder ones to think about here. Now's a good time to look at, if you will, renegotiating that loan. Maybe extending it out a little bit. I mentioned cash was king. One of the easiest ways you can save money is take that 10-year note you've got right now and negotiate and make it a 15-year. Lower those payments. You're still going to cover that debt. It's just that you're taking a little load off you now and extending it a little longer into the future. So yeah, definitely be talking to your lender here as we're looking into 2016. This is another big one, revising our growth strategy. As I mentioned, the past few years, let's face it, farms have gotten larger. We've ramped up. We were chasing after that rented land because we wanted to produce more of that $7 corn and those beans in the teens. Now, some of us are probably a little bit too big for our fields. Is it time to consolidate? Is it time to downsize? Is it time to talk to Dave Baker and talk about what your succession plan is? And it's time to think about the long-term goals that you have in farming. And finally on this note, I'm going to say know what you've got to help you fill in that gaps as far as what the government's going to offer you. We already talked about crop insurance, but it's also a good time to think about to that decision you made a couple of years ago on the Farm Bill. Know what you're going to get from those payments. Now, as you're looking here, as I sit here in central Iowa, you would have received the payments for the 2014 crop about, 3 months ago. Some of you probably got a check, others of you probably didn't. We saw a split in Iowa as to how that looks. As we look at what's shaped up for the 15 crop year, corn payments are probably going to be very similar to what you saw. The bean ones will be a bit different. Because what we really saw, if you think about the 14 crop, that was one where the northern crop was a little light, the southern crop was the record crop. 15, it's the opposite. That's going to change the payout pattern. Best estimates right now, you would get these in October 2016. As we look across northern Iowa, 50 to 60 bucks an acre. Here in central, what? 30 to 50. You get down here, southern Iowa, still low. So are the Farm Bill programs working? Yeah, they're supporting us when we're having these low margins. Are they going to completely fill in the hole? No. But at least you know you've got a little extra cash rolling in at this time. These are for corn. Here's beans, getting the little payments here as well. Again, southern or northern crop not as good. Southern crop's paying out a little more on the bean side. So we are getting some help that way. Our safety net is in place. It is working, but it relies upon it filling in part of the hole and you working to fill in the rest. Now, if you're interested as we go forward here, we've got calculators up on the Ag Decision Maker website to help you work through those. My colleague Alejandro Plastina, he builds these. Did anybody in this room sign up for price loss coverage out of the Farm Bill? Nope, okay. Just to show you, there's a chance for those payments to hit in as well. This thing only kicks in when prices get low. The magic number was 370. And as I mentioned, USDA right now is at 360. So even that's in the money. But it's not there for beans yet. Beans, the magic number is 840 for that to kick off. So I'm going to wrap up in this way. Big summary to me is talk to people. As you're looking at your cost structure there, we need to be talking to that agronomist, that lender, that tax advisor, that crop insurance agent. I'm searching for a little, if I can squeeze a dime out of each of these pieces, well, that can add up to some money in the game here. That was the situation we were in the 90s. That was the situation we were in the 80s. That's the situation we were in the 70s. That is where, was I going to stand here and tell you anything new on the margin side? No, I don't have to. We know the tools that we need to use to improve this margin. We've used them before, we'll use them again. And I'll end with this final note. I hope I'm wrong. I hope my outlook is completely off. That you have a healthy, happy, prosperous, price-rising 2016. And if so, come back here next year, you can throw tomatoes at me. But in case I'm right, don't say you weren't warned. Questions, comments, tomatoes you might have for me now. Yes, sir.
Have you considered encouraging people to seed down 10% of their acres to cover crops and running an analysis on that basis?
Okay, so the question is, have we considered getting people to seed 10% of their acreage to cover crops and then running an analysis on this acre? I got a similar question earlier at another Crop Advantage meeting. One gentleman suggested that everybody just give up an end row to reduce supplies to get ourselves in that picture. Here's I guess the problem or the dilemma with that. For an individual farmer, does it make sense to do that? You're shooting your own foot, as you say there yourself. For the industry as a whole, it makes sense, but for an individual farmer, it doesn't. And so that's why we never see solutions like that work. Because when I'm talking about 90 million acres of corn across this country, how many thousands of farmers am I talking about there? And to get them all to do the same thing, other than plant corn, is nearly impossible. That's why when you're looking at the situations like we're looking at here, that's why you tend to, if you will, you have to wait for the natural disaster. That's what tends to influence the supply structure enough to create some profitability for a crop that will then shift the acreage in the next year to move there. And that's the problem that we've had the past couple of years. We've had good production in corn, in soybeans, in wheat, in cotton, in rice for the past few years. No one's taken a hit since basically 12. And what that's meant is that no crop finds itself in a short situation, which means no crop is offering a profitable opportunity, which means nobody's moving. And while I would agree a situation where if everybody did that, would it improve the market situation? Yes. Will everybody do that? No. And so that's where we find ourselves. Again, if it doesn't make sense for the individual, it's not going to happen. Yes, sir.
In your corn grind for ethanol, there were short-term peaks and valleys.
Yes.
What's that all?
Okay, so the question is, in my graph for ethanol up here, there were short-term peaks and valleys. So let's see if I can get back there quickly. This is a sign I've got too many slides. That guy. So as you're looking at this variation, what's going on there? So, as you look week to week, the idea is just like the corn market, if you will, the ethanol market is responding to short-term pricing incentives.
That's so regular. That's so regular.
Well, it's not necessarily so regular. I mean, you get some jaggedness in here. But the big thing to point out in this thing is there's a couple of different spikes down where you tend to see these lowest spots, usually in September. If you want to think about it this way, that's when those plants, we got through the summer driving season. We know fuel demand's going to drop down, and then's a great time to clean the plant. And so that's why you see, especially this spike here, that was that guy. But you also can see that seasonal variation. As we go through the year, the idea is that what they're really targeting is you want your heaviest production in the summertime, because that's when we're driving the most. You tend to pull back in the winter times when we're driving less, because you don't want that building up in stock levels. And that's what creates that cycle that you see there. But then you can have, little issues at different plants that cause the jaggedness in between. That's what's driving that. Yes, sir.
Yeah. How long does crude oil go and ethanol doesn't have the financial problem?
Okay. Well, again, when you look here, what happened to crude oil? So you had this significant drop, and the reason ethanol didn't feel a lot of that is because that crude oil drop happened at the same time the corn price drop happened. That, if you will, sort of held them harmless. The other thing that's working for this industry is that as gasoline and oil prices have dropped, people are driving more. And so they've seen increased demand for the product. I've noticed that myself as I travel around the roads this year versus last year. I'm seeing a lot more cars on the road at all times, day and night. And as that gasoline consumption rises, that's also helped the ethanol industry. That's helped that demand. Yes, sir. How low can oil go? Given corn right now, I'm going to argue we could get down close to 20 bucks and still be okay. It wouldn't be good. The idea is that you're putting, right now, you've got some plants at break even today. You take them down there, they're going to be below. But we've got other plants that are still profitable today. Thinking about, has oil price been down there? Yeah, we've been there before. But if you think about the ethanol industry, it has improved since then. They're much more efficient. They have figured out ways to extract additional value. So when that bushel of corn goes into that ethanol plant, it's not just ethanol they're producing anymore. You've got your ethanol, you've got your distiller's grains, you've got corn oil. They've got 3 revenue streams now coming off of that bushel of corn.
Is China still importing DDGs?
China is still importing our DDGs, but they are investigating it again. This is the 3rd investigation in a row. They haven't done anything to limit those yet. All right, thank you all very much. Have a great day.